There's a 6-story concrete box in the middle of your city that makes more money per square foot than most restaurants. And most people have never once thought about who owns it. Picture it, a sleek entrance, a red and green light system, a machine that spits out a ticket, and cars gliding in and out all day. You imagine owning one of these and just collecting money. Cars come, cars pay, cars leave. No inventory, no spoilage. No customers complaining about their order. Just steel, concrete, and a gate arm that prints cash. Here's the problem. Almost none of that is how this business actually works. The illusion is that a parking garage is a passive box that fills itself. The reality is a business built on razor-thin utilization math, brutal fixed costs, and a handful of hidden revenue tricks that decide whether you're profitable or bleeding money every single month. Start with the scale of this thing. The U.S. parking industry generates somewhere between $30 and $35 billion a year. There are more than 2 billion parking spaces in the country, more parking spots than people. More parking spots than registered vehicles even. Sounds massive. Now here's the undercut. The average garage operates at a net margin of somewhere between 8 and 15%, not the 40-50% margin you'd expect from something that just charges people to sit still. Most of that revenue gets eaten alive before it ever becomes profit, chewed up by debt, maintenance, and staffing before the owner ever sees a dollar of it. Here's what nobody tells you going in. Parking garage isn't one business. It's 3 or 4 completely different businesses wearing the same concrete shell. There's the transient downtown garage, high turnover, high per visit price, brutal exposure to daily foot traffic swings, and it lives or dies on whatever's happening on the street outside it that day. There's the monthly contract garage, lower per space revenue, but locked in. Predictable cash flow from office tenants who sign a year at a time and rarely shop around once they've found a spot near their building. There's the airport and event garage, feast or famine, massive spikes tied to flight schedules or game days, dead zones in between, and an entire pricing strategy built around squeezing 3 months of profit into 40 peak days a year. And there's the hybrid mixed-use garage bolted onto a hotel or a mall, where parking isn't even the primary profit center. It's a loss leader that subsidizes something else, built specifically to get shoppers or guests into a building where the real money gets made somewhere else entirely. Each of these has a completely different financial personality, a different break-even timeline, and a different sensitivity to the local economy. Building the wrong one, a transient-style garage in a neighborhood that actually needs monthly permits, or an event garage next to a stadium that only hosts 20 events a year, is how sophisticated investors with real capital still manage to lose money before the ribbon-cutting ceremony is even over. Now the part that makes your stomach drop, what it actually costs to put one of these up. Land alone in a mid-sized downtown market runs somewhere between $2 million and $8 million depending on the parcel. Construction of an above-ground precast structure runs $15,000 to $25,000 per parking space, and a mid-sized garage needs 500 to 800 spaces just to be viable, which puts raw construction alone somewhere between $7.5 million and $20 million. Go underground instead, and that per space cost jumps to $35,000 to $60,000 because now you're fighting soil, water tables, and structural engineering instead of just stacking concrete decks. Then come the costs nobody budgets for on day one. Traffic and structural engineering studies, required before most cities will even approve the plans, run $75,000 to $300,000. Permitting and entitlement costs add another $250,000 to $1 million, depending on the city's appetite for red tape and how many public hearings your neighbors demand. Fire suppression and ventilation systems, mandatory in enclosed structures, run $400,000 to $2 million on their own. Add the equipment layer, gate arms, ticketing systems, payment kiosks, cameras, license plate recognition, elevator installation if it's multi-level, somewhere between $500,000 and $2 million for a fully modern setup. And don't forget the striping, signage, and wayfinding package that actually makes the building usable. Another $100,000 to $300,000 that always seems to get forgotten in the early budget. Total it up, and a mid-size urban garage can run you anywhere from $12 million to $35 million before a single car has ever paid you $1. This isn't a side hustle. This is a business that requires institutional-level capital, a very patient bank, or both. So where does the money actually come from once it's built? Here's the layer the average person assumes is the whole business: hourly and daily transient parking. Someone pulls in, grabs a ticket, pays $18 to $40 depending on the city, leaves, feels like the obvious cash cow. It isn't. Transient parking is actually the most volatile, lowest utilization revenue stream in the building, Occupancy on transient spaces averages just 40 to 60% across a given day, because most of your capacity sits empty at 2 a.m. and floods at lunch. It's the layer everyone sees and the layer that actually contributes the least reliable cash flow. Peel back one more layer and you get monthly permit parking, the unglamorous, unsexy backbone of the actual profit. A single monthly space sold to an office worker or a resident might go for $150 to $400 a month depending on the market. It sounds small next to a $40 daily rate, but do the math. A $200 monthly permit works out to under $7 a day, guaranteed every day whether the car shows up or not. Garages routinely oversell monthly permits at a 120-135% ratio because they know not everyone shows up every day. That oversell math, selling more permits than physical spaces, betting on partial no-show, is quietly one of the biggest margin boosters in the entire industry, and almost nobody outside the business realizes it's happening. Third layer, and this is where it gets interesting: dynamic and event pricing. The same space that rents for $18 on a Tuesday afternoon can rent for $60 to $150 during a concert, a game, or a holiday weekend. Operators using dynamic software can push revenue per space up 20 to 40% during peak windows alone, without adding a single spot. This is where the real operators separate themselves from the amateurs. The ones treating every hour of every day the same are leaving six figures a year on the table. And then there's the layer most people never even think to ask about: ancillary revenue. EV charging stations, now installed in a growing share of new garages, can add $0, $20 to $0, 40 per kWh in margin on top of parking fees, and a bank of 10-15 chargers can generate $50,000 to $150,000 a year on its own once utilization climbs. Retail and kiosk leasing on the ground floor, a coffee stand, a shoe shine, a dry cleaner drop-off, adds another stream that has nothing to do with cars at all, often at $20 to $40 per square foot in annual rent. Advertising, wrapped around the exterior or embedded in the payment app, is a line item most people driving past a garage have literally never registered exists. And a well-located structure can pull $30,000 to $100,000 a year just from exterior wraps and digital screens at the entrance. Some operators even sublease rooftop levels to billboard companies or cell carriers for equipment, a passive check that shows up regardless of how many cars are parked below. None of these individually make the business. Together, they are often the difference between a garage that survives a bad year and one that doesn't. Here's the insider trick almost nobody outside the industry has heard of: the pilot structure, payment in lieu of taxes. Cities desperate for parking infrastructure will often negotiate a garage owner's property tax down to a fixed, negotiated annual payment instead of standard assessed value taxation, sometimes for 10, 20, even 30 years. On a building valued at $20 million, that can mean the difference between $400,000 a year in property tax and a locked $80,000 pilot payment. Combine that with accelerated depreciation on the structure. Parking structures often qualify for shorter depreciation schedules than the building itself, sometimes 15 years instead of 39, and you get investors who aren't actually optimizing for operating profit at all. They're optimizing for the tax shelter the depreciation and pilot combo creates, using paper losses to offset income from entirely different investments elsewhere in their portfolio. The parking is almost secondary. That's the real scam nobody prints on the brochure. Some of these garages are worth more as tax instruments than as parking businesses, and the cars driving through them are almost an afterthought to the spreadsheet that actually justified the purchase. Now for the part that erodes the fantasy: $1 at a time, daily operating costs. Staffing, attendance, cashiers, security runs $150,000 to $500,000 a year depending on hours and headcount, and cutting staff to save money usually just shifts the cost into theft, disputes, and machine breakdowns nobody's around to fix. Maintenance is relentless. Concrete spalling repair, expansion joint sealing, painted line restriping. Elevator servicing if it's a multi-level structure. Budget $1 to $3 per square foot annually just to keep the structure from literally cracking apart, because water intrusion on a parking deck is a slow, expensive death sentence if ignored. A small leak today is a six-figure structural repair 5 years from now. Insurance runs $50,000 to $150,000 a year for a mid-size facility. Higher if you're carrying liability for downtown location with heavy foot traffic, and higher still if there's ever been a slip and fall claim on record. Utilities and lighting, especially in an enclosed structure that needs to stay lit 24 hours for safety compliance, run another $30,000 to $80,000 annually. Software licensing for the payment and ticketing systems, the same systems that make dynamic pricing possible, adds $20,000 to $60,000 a year, a cost that didn't exist 20 years ago and that operators now treat as non-negotiable. And if you finance the build, which almost everyone does, debt service on a $20 million loan at current commercial rates can run $1.5 to $2 million a year before you've made a single dollar of profit. Every single day the garage sits there, whether cars show up or not, it's costing you money. Time isn't neutral in this business. Time is the enemy with the meter running on both sides. Here's the structural risk that can collapse the whole model, and it's not bad luck, it's baked in. Most urban garages are financially dependent on a single anchor, a downtown office population that commutes in 5 days a week. Remove that anchor and the entire monthly permit revenue base, remember that's the reliable, predictable layer that lenders underwrite the whole loan against, evaporates almost overnight. This isn't hypothetical. It's exactly what happened during the shift to remote and hybrid work. Downtown garages built and financed on the assumption of 5-day office occupancy suddenly faced 30–50% permit vacancy in major metro cores, with revenue that took years to partially recover, if it recovered at all. Loan covenants written in 2018 assumed a level of daily demand that simply stopped existing by 2021, and operators who had no ancillary revenue, no event pricing capability, and no diversified tenant base found themselves underwater on debt they'd taken out against a business model that no longer matched reality. A business with $20 million in fixed debt and a single point of demand failure isn't diversified. It's exposed, and the whole industry learned that lesson at the same time, all at once, with no warning built into anyone's original financial model. The clearest real-world case study of both the promise and the peril of this asset class isn't even a single garage. It's Chicago's 2008 parking meter deal, and it's worth understanding because it shows exactly how these economics play out at scale. The city of Chicago, facing a budget shortfall in the middle of the financial crisis, leased its roughly 36,000 on-street parking meters to a private investor consortium led by Morgan Stanley for 75 years in exchange for $15 billion upfront payment. At the time, it looked like a win, instant cash for the city's books, a problem solved in a single signature, and a headline the mayor could point to during a brutal budget cycle. Within a few years, independent analysts and the city's own inspector general concluded the deal had been wildly underpriced. Some estimates put the true value of that 75-year revenue stream at $2 billion to $4 billion or more, meaning the private investors were on track to potentially quadruple their money over the life of the lease. Rates for drivers spiked repeatedly under the new operator. Meter hours were extended into evenings and Sundays, and the city lost the flexibility to ever adjust parking policy, to add a bike lane, close a street for construction, or reduce meter hours for a struggling business district, without paying contractual penalties to the private operator, sometimes running into the millions for a single policy change. It became one of the most widely cited case studies in public finance and infrastructure privatization classes precisely because it shows the core lesson of this entire industry. Whoever understands the real long-term revenue math of parking assets, and whoever doesn't ends up on very different sides of the deal. The city needed short-term cash to solve a short-term political problem. The investors understood decades of compounding, structurally inelastic demand for a resource nobody could simply choose to stop needing. That asymmetry, more than any single number in the deal, is the entire parking business compressed into one transaction. So how do the smart, well-capitalized players actually beat these economics? Scale is the first lever. A single garage fights alone against fixed costs, but an operator running 40 or 400 garages across a metro spreads management, software, and staffing costs across a portfolio, turning an 8% margin business into something closer to 20%. Rate structures are the second lever. Several publicly traded parking rates exist specifically because parking real estate throws off stable, bond-like cash flow that institutional capital loves, and rate status lets them avoid corporate-level taxation entirely as long as they distribute most income to shareholders. Third, the wealthiest operators aren't actually chasing operating income at all. They're chasing appreciation and optionality. A downtown surface lot or garage sitting on prime land is, in many cases, a placeholder for a future high-rise, purchased specifically because it throws off enough cash flow to cover the carrying costs while the owner waits for the air rights or the zoning to make a bigger development pencil out. The parking was never the end game for these buyers. It was a profitable way to wait. Now look at the actual swing between a good year and a bad year, because this is where the volatility stops being theoretical. In a good year, a well-located 700-space mixed garage might pull in $3.8 million in gross revenue, combining transient income near $1.4 million, monthly permits running near full oversell at $1.6 million, event and dynamic pricing capture adding $500,000, and ancillary income of $300,000 against $2.9 million in total operating costs and debt service, netting around $900,000. That's a real healthy return on an asset this size, and it's exactly the number that gets quoted in the glossy investment brochure. In a bad year, the same garage tells a very different story. A soft office market drops permit renewals by a third. A construction project blocks the main entrance for 4 months, killing transient traffic during peak hours. The event calendar goes quiet for 2 straight quarters. Gross revenue falls to $2.6 million, while fixed costs barely move because debt service and most maintenance don't care about your occupancy rate. The bank still wants its $1.7 million, whether or not a single car parked that month. Net profit in that scenario can collapse to $150,000 or turn negative entirely if a major tenant walks or a bank tightens lending terms mid-cycle. Not a 20% swing. A swing that can wipe out 80-90% of your annual profit from one bad year to the next, on a building that cost you tens of millions of dollars to put up in the first place. So is it worth it? It depends genuinely, not as a hedge, on which version of this business you're actually buying into. If you're a small operator trying to run a single transient garage on hope and daily rates, this business will quietly ruin you because you're exposed to the most volatile revenue layer with none of the scale to absorb a bad year, and one bad construction project next door can wipe out 18 months of margin. If you're a mid-size operator with 2 or 3 properties and a solid mix of monthly permits, you can build something genuinely stable. But you're still one office tenant's relocation away from a very uncomfortable year. If you're an institutional player who understands pilot structures, depreciation schedules, dynamic pricing software, and portfolio-level scale, this is one of the most stable, boring, cash-generating asset classes in commercial real estate, which is exactly why pension funds and rate quietly love it, and why you'll rarely see a parking rate make headlines the way a flashy tech stock does. Boring in this business is the entire point. The people who make real money here aren't the ones charging you $22 to park for 2 hours. They're the ones who understood decades ago that the real asset was never the cars at all. A parking garage was never really selling parking. It was selling patience, land, and time, and charging you by the hour to remind you of it.